And then we have the trust. A trust can play an important role in asset protection, succession planning, and holding family or investment assets, but it must be used for the right reasons and managed properly. Trusts are also separate taxpayers, as with the company, and income retained in an ordinary trust is taxed at a high flat rate of 45%. Where the trust deed allows it, though, income may be distributed to the beneficiaries and taxed in their hands instead. That's what we call the conduit principle. So however it comes into the trust is the same form that it goes out and gets taxed in the beneficiary's personal hands. If distributions are made, they must be properly authorized, correctly recorded, and supported by the trust deed and trust resolutions. A trust may be useful where the objective is long-term protection of assets, protection for vulnerable beneficiaries, or a clear succession plan and protection of generational wealth. The key point is that the structure should never be chosen for convenience alone. It should align with the long-term strategy of the business. But this is easier said than done. We have scenarios where a client urgently needs a company. They're buying a property. It might make more sense to put it into a trust, but we all know registering a trust these days takes months, if not years. And we can register a company within a week. So sometimes a decision is made based on that. Changes can be made later. We can also provide a shelf company for immediate purposes, but you don't get shelf trusts. We can also consider changes in shareholding, including the dilution of shares as part of a broader tax planning and business structuring. When a company issues new shares, existing shareholders may be diluted, which means their percentage ownership, voting power, and future dividend entitlement can reduce if they do not participate in the new issue. Dilution can be a useful tool to raise capital, bring in strategic investors, or restructure ownership, but it does need careful planning. The valuation of the company and the price at which the new shares are issued are critical, as these affect fairness between shareholders and can have tax consequences in certain transactions. Share dilutions are also useful when a new generation is taking over the family business. Instead of paying huge capital gains tax on the sale of their shares, we structure as a dilution and issue new shares. We've done quite a lot of this recently, where you see the new generation coming in. The existing shareholders will still hold shares, but a much lower percentage, whilst the new shareholders take on the larger shareholding. Or even better, the new additional shares are issued to a South African trust, thereby ticking the generational wealth protection box of reducing estate duty and not resulting in further capital gains tax in an individual's name further down the line. The shareholder change in these kind of scenarios needs to support growth without creating avoidable disputes or unintended tax exposure.